In this video, I'm going to talk about 10 Canada Pension Plan myths, and if any of these myths trip you up, it could end up costing you money through your retirement years. So it's really important that we make our Canada Pension Plan decisions based on facts and understanding how this plan works. And it's a very important part of your overall retirement income planning. When you think about it, retirement planning is a pyramid. At the base of the pyramid will be your government benefits, CPP, old security. In a couple situation, that's not insignificant income. So how does this work? You'll be having coffee with a friend, you're talking about retirement, maybe at work, and facts get thrown out about Canada Pension Plan. You're at Thanksgiving or a family get-together and the topic comes up. And I'm often on the outside of those conversations listening in, and it's always surprising to me the amount of misinformation that's out there. So we're going to talk about these common myths, and then I'm going to talk about the facts that are attached to many of these myths that are out there. So hopefully you can make some great decisions and have peace of mind and confidence you're doing the right things, not only for Canada Pension Plan, but your overall retirement plan that you're putting together. Now, first of all, let's just take a look at myth number one. You must take Canada Pension Plan at age 65. And of course, that's not accurate. You can take it as early as age 60, and you can defer it to age 70. So if you take it early at age 60, you are subject to an actuarial penalty that'll reduce your benefits. So it'll be a 36% hit to what your benefit would be normally at age 65. If you defer to age 70, that's a 42% enhancement. But the bottom line is you need to make this decision in the context of your health, your finances, and your life expectancy expectations. So we have clients that are a little bit cynical about how long they're going to live. So they'll subscribe to a take the money and run philosophy. They'll take it as early as they can, and that's fine. And we have other clients that longevity is in their family, and it could very well make sense for them to defer the benefit and get that enhancement. We have some clients that will take it later because they're trying to create a tax window where they could draw money out from their registered accounts at a lower tax rate. And we have some clients that go, I know there's going to be that penalty. What I'm going to do is I'm going to pull it out early, just in case. I'm not sure how long I'm going to live for. I'm going to take that money and I'm going to reinvest it. And so the compounding growth for a few years of that cash flow I'm getting from CPP will help to compensate from the penalty that I'm experiencing. So the bottom line is there's no one size fits all. It's very customized, not black and white. And so you need to work out your own plan and customize it to your particular situation. Okay, that's the first myth. Myth number two, CPP provides enough retirement income. Now, where does that come from? I think it's just this general throwaway statement. I've heard people say, I've got a pension plan at work, so I'm good. It's a little more detailed than that. So if you look at the facts of Canada Pension Plan, the average benefit paid $750 a month across Canada. The maximum is $1,400. And for many retirees, it's going to amount to between 25 and 33% of their pre-retirement earnings. And most people are going to need probably 70 to 80% of their working income when they retire. So this gets back to the idea that having a plan in place is really important. At the foundation, you're going to have your old age security, your Canada Pension Plan benefits. You might have some pension through work, and maybe you've got savings through RRSPs or TFSAs, maybe some money in your business. But you need to build a plan to get a sense as to how much you need to have in savings to get you up to that 70 to 80%. Now, the ideal way of looking at that is what are your after-tax income needs, build in some inflationary estimates, and then work backwards in terms of required savings. So it's really important to have some plan in place to give you confidence that you're tracking in the right direction in terms of required assets when you retire. Now, myth number three is you must stop working to collect Canada Pension Plan. That's not the case. There were more restrictions many years ago, but you do not have to stop working to collect it. So under the age of 65 and working, you must make Canada Pension Plan contributions. So you can't start taking it, let's say at age 60 or 61, continue working and say, I don't have to put any money in the plan anymore. You have to keep putting money in. Any contributions you do make are triggering what's called a post-retirement benefit. So you get little additional increases to your benefit from Canada Pension Plan. And those benefits will be indexed to inflation as well. So it's not an insignificant long-term benefit when you go through that. And let's look at a few more facts around this particular myth. Number one, you have to make contributions between the age of 60 and 64. Number two, between the age of 65 and 70, you do continue making contributions to CPP if you're working. However, you can make an application to stop those contributions. So that's Form CPT 30. It needs to be filed with the government and with your employer. And once that's submitted, then you can have that arrangement made so there's no deductions. You have a little more money at source from your employment earnings. If you do not submit that form, then you're required to make those contributions. And then at age 70, contributions end automatically. Let's look at myth number 4. CPP funds will run out. Now, a lot of people think this, and yet it's very well run. Canada Pension Plan is expected to remain sustainable for the next 75 years. It's managed by the Canada Pension Plan Investment Board. There's almost $600 billion of assets in the plan. And the actuarial health of the plan is being reviewed on a regular basis. So several years ago, there was a bipartisan initiative by Parliament to look at Canada Pension Plan and make sure that it was solvent long-term. So they've made some major adjustments. One of the biggest adjustments is having an independent group managing. So the CPP Investment Board is managing it. They have a fiduciary responsibility to make sure that portfolio grows commensurate with what the return requirements are to fully fund these pensions. So it's good shape. Now, where the concerns do come in often with government benefits would be old age security. Old age security is a tax-funded plan, pay as you go. And if we do see some deterioration in the economic stability and health of the government, if we see the economic situation deteriorate in Canada, and we've got a bit of a demographic time bomb, lots of aging in the population, you could see governments being motivated to play around with old age security benefits, as an example, where they say maybe the clawback level needs to be pushed down further so that we capture more and more people, and that's for a clawback zone. Maybe we don't have as generous indexing on the plan. So I suspect there could be changes. The U.S. Social Security program is pay as you go. It's not in great shape, and they need to make some pretty important decisions around those plans. But Canada Pension Plan itself, very solid. It's in really good shape. Myth number 5, cannot collect Canada Pension Plan if you're living outside of Canada. Yeah, that is a myth. Benefits are paid worldwide, and if you've built up both Canada Pension Plan and old age security benefits, they can be paid into a Canadian bank account or foreign bank accounts, or you basically pay a Canadian account, do a transfer to your foreign account. For non-residents, there is a 25% withholding tax, although if there's a reciprocal tax agreement between Canada and the jurisdiction you're domiciled, you might be able to get that withholding tax either reduced or you might get some of it back when you file in your jurisdiction. So it's important that you be aware of that. Yeah, you can move someplace else and continue to get those benefits. Myth number 6, Canada Pension Plan benefits are the same for everyone. Well, that's incorrect. They can be quite variable. And of course, your Canada Pension Plan benefits are based on average earnings and years contributed. The calculation uses your best 40 years of earnings up to age 70. And lower income or time off work reduces benefits potentially. And child rearing dropout provisions are available that could enhance the final benefit you receive. I think that the most important thing here is for some people, you want to be a little bit tactical. So make sure you have your Service Canada account. Go in and look at your earnings history, your contribution history. And you could have some years where you weren't making contributions, where you had lower income. And that's where it may make sense to extend your working history a little bit, enhance your benefit by having higher insurable earnings in the calculation. So it may not make a huge difference in the final numbers for you, but I would encourage you to take a look at that. So again, go to Service Canada, get your employment history. I'll have a link to some calculators where you can actually input your numbers, play around with if I add another 1 or 2 or 3 years of employment earnings and increase my average in the calculations. What does that do in terms of my final benefit? And so make sure you look at the show notes for the links for that. Myth number 7, you should always take Canada Pension Plan benefits early at age 60. That may in fact be the right decision for you, but it is quite variable. So let's just talk about this a little bit. If you look at, again, life expectancy in your family and how long you think you might live, there could be some utility in backing up the benefits. So what I would say is that most people will take their Canada Pension Plan early. Is that the right decision? Not necessarily, but it's the common decision. So if you retire at 60, 61, 62, the majority of people will take it early. But you do need to take into account some of the other things I've talked about already. There could be some tax planning reasons why you wouldn't take it early. Longevity expectations, as an example, waiting to age 65 for your benefit would lead to more total benefits paid if you could live to, let's say, age 74, right? So the break-even point would make sense in that scenario. And that's a pretty high probability, right? If you look at deferring to age 70, then the greatest payout then hits by the time you get into your early 80s. But even that number for the vast majority of Canadians, that's average life expectancy. Most people will live a little bit past that, right? Males will be a little bit more longer than that, potentially females for sure. So again, you need to look at your own particular circumstances. But when it comes to taking the benefit, I get it. Most people subscribe to the idea of take the money and run. And the only way that they would defer that strategy is if there's other winning strategies around tax planning, as an example, that could push them over the edge to make that decision. In our software applications, we have this comparison tool that allows us to build various start dates for government benefits. And then the tool will do what's called a net present value calculation. So it'll tell you in current dollars which scenario is going to put the most amount of money in your pocket. Now, it's important to know that number because even though the deferring past age 65 scenario may be a win for you from a number standpoint, you need to know what that buys you in current dollars. And for some people, they'll look at the number and say, that's not very much. I think I'm going to take my benefits from CPP early. Other people will look at the number and go, wow, that's significant. I think I'm going to defer. So again, it gets back to doing your homework so you can find out which option makes the most sense for you. Now, myth number 8 relates to survivor benefits replace deceased full pension. So this idea that if your partner passes away, you're going to get that benefit replaced in your family cash flow. And that is not going to be the case. So what happens generally for people, and it's one of the reasons I really recommend that they have a first to die calculation done in their planning. Ideally, you should look at those numbers before you retire because sometimes it can tie into whether you should continue carrying life insurance, converting group benefits. And so what you want to ask is, if in a first to die situation, if I predecease my spouse, what is their cash flow going to look like? They're going to lose an old age security benefit potentially. They're going to lose a portion of the CPP likely. They may lose some of the employer-sponsored pension plan because it may not be 100% survivorship benefit. It might be 2/3 or 50%. So it's definitely going to be a hit to cash flow. And you just need to look at the numbers and see whether the after-tax requirement for the surviving spouse is doable when you see the loss of those incomes. So when you look at the benefit rates for Canada Pension Plan, it's a capped formula. So it combines survivor benefits with the recipient's own CPP entitlement. So it's not like a top-up. You may receive a little extra if you're collecting maximum benefit, probably unlikely. For most couple situations, if you both are getting basically max CPP, one of you passes away, there's no residual benefit really to speak of. You'll get a $2,500 check for the surviving partner, but that's really it. So that income source is gone. Myth number 9, you cannot increase your pension plan after you start collecting it. So we've already talked about this particular issue a little bit in the previous myths that we've gone over. Of course you can. So if you continue working, you'll be able to accrue some additional benefits through the post-retirement benefit addition to your CPP benefits. And you can be a little bit tactical around that. That could have a meaningful impact in terms of your long-term cash flow. Myth number 10 is RRSP withdrawals affect Canada Pension Plan benefits. They don't, at least not directly. So what I'm alluding to there is that sometimes people confuse this issue with old age security benefits as an example. So for old age security benefits, once you hit net taxable income in just over $90,000 and then up to $148,000 roughly, you could see your old age security benefit fully clawed back if you've got income. And it could be worldwide income, not just in Canada. If you're living abroad, the calculation applies to worldwide income. With Canada Pension Plan, it's more nuanced than that. So again, when we talk about the meltdown strategies and getting money out of your RRSP RRIF accounts in the early years, you can average out the tax rate and maybe end up keeping more total income from all sources, not just your RRIF and RRSP payments, but also your CPP and old age security. So although those withdrawals don't directly impact CPP, unlike your old age security potentially, they do have an impact on the average tax rate over your life expectancy that you might pay. And so again, that's where having a bit of a plan in place to forecast in the future could give you the most accurate way to draw down or deaccumulate your assets to keep more money in your pockets. Well, I hope covering these myths was helpful as you plan out your retirement. The most important thing is to have a plan in place so you can coordinate these different trade-off decisions. And if you like this video, you like the one that's on your screen right now.